Every economic crisis creates winners and losers. The 2008 crash made fortunes for those who shorted the housing market, bought distressed assets, or positioned correctly. The COVID pandemic created trillion-dollar tech companies while destroying small businesses. The 2026 crash is no different. While millions lost jobs, homes, and life savings, some individuals, companies, and entire categories of workers emerged stronger. Not through luck, not through unethical behavior, but through structural positioning that aligned with post-crash economic realities. 5 years after the crash, the new economy has clear winners. They're not who you'd expect. Not the traditional elite, though some wealthy survived fine. Not the companies that dominated before, though a few adapted. The winners are those who possessed specific characteristics that became valuable when the old economy collapsed. Let me show you exactly who wins in the post-2026 economy. The individuals, the professions, the companies, the regions, the investment strategies, the common patterns across all winners, and why their success is structural, not temporary. What James has: genuine scarce skills, non-offshoreable work, essential service, no debt burden, modest living costs. These characteristics define individual winners. The infrastructure software engineer, Maria, 29 in 2026. Back-end engineer at mid-sized tech company, specialized in database optimization and system reliability. Pre-crash comp, $165,000. During crash, tech layoffs hit 38% of industry, but infrastructure engineers were protected. Companies couldn't cut engineers maintaining critical systems. Maria's company laid off 62% of product team, 71% of marketing, 54% of sales. They laid off 0 infrastructure engineers. Maria's comp was cut to $145,000 in 2027, 12% reduction. But she kept her job. By 2028, companies desperate for infrastructure talent competed for limited engineers who survived. Maria's comp rose to $178,000. By 2030, Maria earns $195,000. She moved from expensive San Francisco to Austin, cutting living costs 55%. Her effective purchasing power increased 85% from pre-crash, despite nominal increase of only 18%. She's accumulating wealth rapidly while peers struggle. What Maria has: specialized technical skills in critical function, ability to work remotely enabling geographic arbitrage, scarce expertise companies must retain. The nurse practitioner, David, 41 in 2026, nurse practitioner in primary care. Pre-crash income, $108,000. Worked in understaffed urban hospital. During crash, healthcare demand increased. Stress-related health problems, delayed care creating backlog. Aging population.NP employment actually grew 4%. David's hours increased from 36-week to 42-week. Income rose to $118,000 in 2027 despite recession. Why? Genuine shortage of healthcare providers. Hospitals couldn't find enough NPs. David had negotiating power when most workers had none. By 2030, David earns $132,000. Hospitals compete for NPs. Travel nursing rates are premium. David works 3 12-hour shifts per week, earns more than most professionals working 50-plus hours. What David has: essential service, genuine labor scarcity, non-discretionary demand, portable credentials enabling competition between employers. The pattern across these individual winners: valuable skills that are scarce, essential, and non-substitutable. They aren't competing against oversupply of interchangeable workers. They provide services that must be delivered locally by qualified individuals. Part 2, the corporate survivors, companies that adapted. Among corporations, winners weren't necessarily the largest or most prestigious pre-crash. Winners were those that adapted to post-crash realities fastest. Amazon, the infrastructure winner. Amazon entered crash as e-commerce and cloud leader. During crash, both businesses exploded. Retail shift from stores to online accelerated. Cloud adoption accelerated as companies digitized. Amazon hired 340,000 warehouse workers 2026-2029, while retail overall lost 2.1 million jobs. AWS revenue grew 43% from 2026-2030, while enterprise IT spending fell 18% overall. Amazon captured share in shrinking but digitizing market. By 2030, Amazon worth $2.8 trillion, up 87% from pre-crash. Employed 2.4 million people globally. Dominant in e-commerce, 47% market share. Cloud infrastructure, 39% market share. Logistics. Why Amazon won? Positioned in structural growth trends, e-commerce, cloud, asset-light business model, massive scale advantage, essential infrastructure status. Utility companies, the boring winners. Utility companies were unsexy pre-crash. Post-crash, they're steady wealth creators. People cut everything discretionary. But electricity, water, natural gas, non-negotiable. Southern Company, Duke Energy, NextEra, all maintained dividends through crash. Stock prices fell 25 to 30% during crash, but recovered fully by 2029. Provided stable returns in chaos. Utility stocks became wealth preservation vehicles. Rich families shifted from growth stocks to utilities. Yield of 4 or 5% plus safety beat 0.5% savings accounts and crashing tech stocks. By 2030, Utility sector up 8% from pre-crash, while S&P 500 down 21%. Not exciting, but preservation of wealth beats destruction of wealth. Why utilities won? Non-discretionary demand, regulated returns, infrastructure assets, dividend sustainability. Discount retailers, the down market winners, Dollar General, Walmart, Costco thrived while upscale retail died. Consumer downtrading, buying cheaper versions of everything, drove traffic to discounters. Dollar General opened 3,400 new stores 2026 and 2030. Walmart grocery share increased from 21% to 31%. Costco membership grew 18%. Meanwhile, Nordstrom closed 42% of stores, Macy's closed 38%, Bloomingdale's closed 29%. By 2030, Dollar General stock up 34% from pre-crash. Walmart up 19%, Costco up 23%. Department stores down 60 or 80%. The shift to value was permanent. Why discounters won? Serving customers with less money, efficiency advantage over competitors, scale enabling lower prices, positioned for down market consumption shift. Defense contractors, the geopolitical winners, Lockheed Martin, Raytheon, Northrop Grumman, benefited from geopolitical instability following crash. Government spending on social programs was cut. Defense spending increased. Why? Economic stress increased international tensions. Resource competition intensified. Authoritarian governments became aggressive. Democracies felt threatened. Defense budgets rose even as overall budgets fell. By 2030, defense stocks up 42% from pre-crash. Revenues growing 6% annually, margins expanding. Government contracts guaranteed revenue. Why defense won? Government customer, guaranteed spending, geopolitical tailwinds, insulation from consumer economy. The pattern across corporate winners, essential services, structural positioning in post-crash economy, business models aligned with new consumer behavior, or insulation from consumer economy entirely. Part 3. The geographic winners, cities and regions that thrived. While Tier 1 cities collapsed, certain secondary cities and regions became major winners by attracting people and companies fleeing expensive coastal metros. Austin, Texas. The tech migration winner Austin population grew 14% from 2026-2030. Tech workers fled San Francisco, Seattle, New York. Companies opened major offices. Remote workers relocated for quality of life. Pre-crash. Austin, 1.2 million metro population, median home $465,000, vibrant but manageable. Post-crash Austin 2030, 1.16 million population, median home $385,000, fell during crash, recovered partially. Thriving tech hub, quality of life, lower costs than coastal cities. What Austin offered: no state income tax, 60% lower housing costs than SF, good weather, educated workforce, existing tech ecosystem. The value proposition was overwhelming. Companies followed talent. Oracle HQ moved to Austin. Tesla expanded Austin operations. Meta, Google, Apple all opened major Austin offices. The city captured tech migration. Tax revenue increased. Infrastructure investment followed. Austin became self-reinforcing winner. Success attracted more success. Raleigh-Durham, North Carolina, the education healthcare winner. Triangle region grew 12% from 2026-2030. Combined 3 universities, UNC, Duke, NC State, with major healthcare systems and affordable living. Attracted biotech companies, pharmaceutical research, healthcare admin. Also tech companies seeking educated workforce at lower cost than coastal cities. By 2030, median household income $84,000, 17% above national median. Unemployment 4.2% versus 8.8% national. Housing affordable at median $342,000, virtuous cycle of growth. Nashville, Tennessee, the service economy winner. Nashville grew 11% from 2026-2030. Healthcare, music, tourism, business services. No state income tax, lower costs. Southern hospitality culture. Healthcare companies concentrated there. HCA Healthcare, community health systems. Finance companies moved back office operations. Cost advantages were substantial. Denver, Colorado, the quality of life winner. Denver grew 9% despite higher costs than Austin or Nashville. Why? Outdoor recreation, educated population, legal marijuana, lifestyle appeal. Attracted workers who could command high salaries remotely and wanted mountain access. Remote tech workers, consultants, finance professionals moved for lifestyle. The geographic winner pattern: lower costs than coastal cities. Quality of life, business-friendly governance, existing industry clusters. Ability to absorb migration without infrastructure collapse. These cities won by being good enough on everything and excellent on cost. They couldn't match SF on tech ecosystem or NYC on finance depth or LA on entertainment, but they were 70% as good at 40% the cost. The value proposition was unbeatable. Part 4, the investment strategy. Winners, contrarians, and cash holders. Among investors, winners weren't those who predicted crash perfectly. That's nearly impossible. Winners were those positioned to buy distressed assets when others were forced to sell. The cash holder who bought assets. Consider investor who held 40% cash pre-crash. Unconventional allocation. Financial advisors mocked it. Cash is trash. Opportunity cost. Uninvested money. Pre-crash, $1 million portfolio, $400K cash, $600K stocks, bonds. The $400K cash earned 0.5% while stocks returned 12%. Looked foolish. During crash, stocks fell 45%. Investors' $600K in stocks became $330K, but $400K cash unchanged. Total, $730K versus someone who was on 100% stocks with $550K. The advantage, investor had $400K dry powder to deploy. Bought stocks at 45% discount. Bought foreclosed homes at 35% discount. Bought distressed bonds at 70 cents on dollar by 2030. Original $400K cash deployed in distressed assets worth $780K. Original $330K in stocks worth $475K total, $255 million. Versus 100% stock investor with $790K. The cash holder won by 59%, not through prediction. Through having ammunition when others needed to sell. The shorts who timed it. Small group of investors who shorted over-leveraged companies, commercial real estate, weak banks made fortunes. Michael Burry-style bets. Pre-crash short positions. $10 million betting against office rats, over-leveraged retailers, zombie corporations. Cost of puts and shorts, $1.2 million in premiums. During crash, positions paid off massively. Office rates down 65%, retailers bankrupted. Zombie corps defaulted. The $10 million in short positions generated $47 million in profits. By 2030, $47 million deployed in distressed real estate, high-yield bonds, undervalued stocks. Where $68 million turned $11.2 million investment into $68 million. But this required correct timing, conviction to maintain expensive positions, emotional fortitude, sophisticated understanding. 99.5% of investors couldn't execute this. The distressed real estate buyers, investors with cash who bought foreclosed homes, distressed commercial properties, underwater mortgages. Example, a buyer purchased 40 single-family homes in Phoenix at median, $185,000 in 2027 to 2028. Total investment, $7.4 million, including renovation. Properties worth $425,000 pre-crash. By 2030, properties worth $310,000 median. Portfolio worth $12.4 million. Cash flow from rent, $420,000 year net. Total return, 68% capital appreciation plus 5.7% annual yield. The corporate bond contrarians. Investors who bought investment-grade corporate bonds during panic when spreads hit 850 basis points. Bonds trading at 62 cents on dollar at worst of crash. Investor bought $10 million face value for $6.2 million to bet that companies wouldn't default, just stressed. By 2030, 92% of bonds survived without default. Investor holds $9.2 million in performing bonds worth $8.8 million at market, recovered to 96 cents, plus collected coupon payments of $2.1 million over 4 years. Total return, $11 million on $6.2 million investment, 77% return in 4 years. The investment winner pattern, dry powder, cash, to deploy when others couldn't, emotional discipline to buy during maximum fear, correct assessment of value versus distress, patience to hold through recovery. Retirement income, $4,200 a month, $2,200 Social Security, plus $2,000 pension and $401K withdrawal. Surplus, $400 a month. And during crash, their 401K fell 45% from $380,000 to $209,000. Their pension was reduced 12% in COLA adjustments. Their income fell to $3,050 a month. But no debt meant $3,150 still exceeded $2,800 needs. They cut discretionary spending, no travel, no dining out, minimal entertainment. They survived comfortably. Contrast with retiree couple with mortgage. With only $400 month mortgage plus $2,800 other expenses, $5,200 needs. Same income decline to $3,050 creates one night or 4 to 50 month shortfall. They must drain savings or sell house at bottom. By 2030, debt-free couples 401k recovered to $301,000. They've lived comfortably through entire crisis. Mortgage couple had to sell house at loss, drain savings, move to cheaper area. Two completely different outcomes based solely on debt. The debt-free winner pattern, flexibility in crisis, no forced selling, ability to reduce expenses to match income, survival capacity enabling recovery capture. Part 6, the social capital winners, networks over net worths. Unexpected winners were those with strong social networks who could access support, opportunities, and resources without deploying financial capital. The community organizer, consider Marcus, 39 in 2026. Community organizer in Detroit pre-crash income, $42,000. No significant savings, no assets. Looked like loser on paper. But Marcus had relationships with 300 plus community members, church networks, neighborhood associations, local business connections. When crisis hit, this mattered more than money. Lost job in month 3 of crash. But friend ran construction crew, needed help, worked there. Friend's cousin needed someone to manage rental properties, did that. Church member needed admin help for small business, did that. Marcus worked 3 to 4 gig jobs simultaneously through network connections. Combined income, $38,000 to $45,000 depending on month. Not great, but survived. Meanwhile, professionals with $150K pre-crash salaries and no networks couldn't find any work. Their specialized skills were unmarketable. Their networks were corporate colleagues, all also laid off. By 2030, Marcus earns $51,000 managing operations for Community Development Corporation, job created specifically for him by network contacts. He has influence, relationships, community position worth more than modest income suggests. The extended family winner. Consider multi-generational household. Parents, adult children, grandchildren living together. Pre-crash seemed like failure. Adult children couldn't afford their own places. During crash, this became winning arrangement. When adult children lost jobs, had housing. When parents needed elder care, family provided. Pooled resources covered collective needs. Housing cost, $2,200 month mortgage for 4-bedroom house. Shared by 3 employed adults and 2 retirees with fixed income. Per capita housing cost, $440 month this individual apartments at $1,600 month. Childcare. Grandparents provided instead of paid care at $2,400 a month. Elder care, adult children provided instead of paid care at $500 a month. Value of intergenerational support, $7,900 a month. By 2030, family accumulated $47,000 in collective savings, paid off mortgage. 2 adult children bought nearby homes with family help. Multi-generational arrangement allowed capital accumulation impossible for isolated nuclear families. The bartering network participant. Consider a suburban neighborhood that created informal economy. Skills exchange, resource sharing, bartering. During crash, members traded services. Electrician fixed wiring for mechanic, who fixed car for teacher, who tutored kids for accountant, who did taxes. Cash economy shrank, barter economy expanded. This network enabled families to maintain living standards with 30% less cash income, saved $500 a month per household through shared resources and bartered services. By 2030, network formalized into a time bank. Track hours contributed and received. 170 families participating, providing collective value of $2.3 million annually in services. Reduced cash needs increased resilience. The social capital winner pattern. Relationships that provide access to opportunities and resources. Ability to create value through connection, not just capital. Resilience through mutual support. Reduced dependence on cash economy. Part 7. The mindset winners. Those who adapted fastest, final category of winners. Those with psychological adaptability to accept new reality and capitalize on it rather than mourning the past. The career pivoter. Consider Amy, 31 in 2026. Marketing manager earning $78,000, laid off month 4 of crash. Could have spent 18 months applying for equivalent marketing roles. Instead, pivoted, enrolled in 16-week coding bootcamp. Cost $14,000 from emergency fund. Calculated that marketing jobs were permanently reduced, tech infrastructure jobs more stable. Month 9, completed bootcamp. Junior developer role at $62,000. Below previous salary, but employed when most marketers unemployed. Learned aggressively. Focused on infrastructure and databases, most stable areas. Promoted after 18 months. By 2030, earning $94,000 as mid-level back-end engineer. Higher than pre-crash marketing salary, better stability, better trajectory. Amy won by abandoning sunk costs. Didn't wait for marketing to recover. Retrained for skills the new economy valued. 24 months of pain, but positioned for recovery. The geographic opportunist. Consider Jason and Melissa, 34 and 32 in 2026. Living in Seattle, Jason tech worker earning $152,000. Melissa, teacher earning $58,000 month 6. Jason's company announced permanent remote work. Couple had choice, stay in Seattle paying $3,600 month rent, or relocate. Moved to Boise within 45 days. Rent $100 to $400 month for a larger house. Jason kept $152,000 salary. Melissa found teaching job at $54,000. Combined income down 7%, housing cost down 61%. Savings rate increased from 12% to 38% of gross income. Despite crash, accumulated $89,000 in savings 2027-2030, while Seattle friends drained savings. By 2030, down payment for house in Boise. Jason earns $168,000 remotely. Melissa earns $59,000. Lower costs, better quality of life, accumulating wealth. Won through ruthless geographic arbitrage. The expectation adjuster, consider Daniel, 43 in 2026. Mid-level corporate manager, earning $95,000, laid off month 5. Could have held out for equivalent role, adjusted expectations instead. Month 8, Took warehouse supervisor role at $52,000. Swallowed pride, told himself, stable job beats prestigious unemployment. Learned operations, logistics, discovered he was good at it. Promoted to operations manager after 14 months. Then regional operations director by 2030, earning $87,000. Not back to pre-crash salary, but employed continuously, building expertise in growth industry, logistics, e-commerce, positioned better than peers who held out for corporate management roles that didn't return. Daniel won by accepting reality faster than peers. No cognitive dissonance, no denial, immediate adaptation. The adaptation winner pattern, rapid acceptance of new reality, willingness to abandon sunk costs and previous identity, ruthless pragmatism over pride, aggressive repositioning for new economy. Conclusion. The common thread among all winners. Looking across individual winners, corporate winners, geographic winners, investment winners, debt-free winners, social capital winners, and mindset winners, a common thread emerges. Winners weren't those best positioned in the old economy. They were those best positioned for the new economy. This required either already having the right characteristics, skills, location, networks, or adapting to acquire them faster than others. The specific winning characteristics, scarce and essential skills, not credentials, but actual capabilities in demand with limited supply, trades, technical infrastructure, healthcare. Minimal debt, freedom to survive revenue declines, flexibility to relocate or change careers, no forced selling of assets. Geographic flexibility, ability to relocate to lower cost areas, capture arbitrage between salary and living costs, move to opportunity. Social capital, networks providing access to opportunities, resources, and support without requiring financial capital. Adaptability, psychological capacity to abandon sunk costs, adjust expectations, retrain, pivot careers, accept new reality. Dry powder, cash or access to capital to deploy when others forced to sell, buy distressed assets at bottom. Essential positioning, in industries, roles, or companies serving non-discretionary demand or critical functions. What's notable, wealth alone didn't guarantee winning. Rich people with all assets and stocks, expensive mortgages, and no essential skills lost. Middle-income people with essential skills, no debt, and adaptability won. Education alone didn't guarantee winning. PhDs in oversupplied fields lost to electricians with scarce skills. MBAs lost to nurses with essential services. The new economy sorted based on genuine value creation, not credentials or previous status. This was harsh but clarifying. Winners created real value or positioned to capture value others created. Losers had positional value in system that collapsed. By 2030, the new hierarchy is clear. Top tier. Technical specialists in skilled trades and essential services, debt-free with geographic flexibility. Second tier, corporate survivors in essential industries, investors with dry powder who bought distressed assets. Third tier, adaptable workers who retrained or pivoted to valued skills, strong social capital networks. Bottom tier, credentials-based professionals in oversupplied fields, debt-burdened and inflexible, waiting for return of old economy. The old economy isn't returning. The new economy rewards different characteristics. Winners are those who recognized this fastest and positioned accordingly. Losers are those still waiting for restoration of the past. The crash of 2026 was Darwinian selection event, not survival of the richest or most educated, survival of the most adapted to new environment. 5 years later, the adapted are thriving. The maladapted are struggling. The selection pressure continues. Who wins in the new economy? Those with genuine scarce value, minimal obligations, maximum flexibility, strong networks, and psychological adaptability. Not who you'd expect from the old economy's hierarchy, but exactly who you'd expect from basic economic principles applied to new scarcity patterns. The new economy has created new winners. They weren't the old winners, that's the point.